Welcome to all of you for tuning in and joining us tonight for this CEC webinar on estate planning. My name is Karl Hutterer. I am the CEC Legacy Giving Advisor. Welcome also, and thank you for joining us to a great panel of experts whom we hear from tonight. And welcome to the CEC webinar series, which is a service CEC provides. CEC is a 2020 California Nonprofit of the Year. And if you would like to know more about CEC, its DNA. CEC's DNA is it advances rapid and equitable solutions to the climate crisis. This is what CEC does. The webinar you are part of today is being recorded, and you will receive a link to the recording and other resources after the event. This is an interactive session, and your engagement is welcome. We invite you to add questions to the Q&A feature on the Zoom panel during the presentation, and we will answer some of the questions during the event, but most of them at the end during a Q&A session. The presentation itself will take about an hour, and then another 20-25 minutes or so for Q&A at the end. We apologize in advance if we cannot answer every single question during the event itself. If you do not get your question, I will endeavor to collect the questions that you have posted on the Q&A feature and get back to you with answers after the event, tomorrow or the next couple of days. Please use the chat feature for any other comments you may have or information you want to share. And we would appreciate it if you would add your name, location, and affiliation, if any, to the chat so that we can link up with you properly. We have a wonderful support team at CEC to help us with Maddie Broughton, who you will see as one of the panelists, and Sarah Miller, who is monitoring the chat and Q&A. So now let's start with a very simple poll. We would like to know a little bit about your background. It will help us providing you the right kind of information. Can we put up the poll? Here is the poll. Please, if you are willing, type in your answers in the poll and then submit it, and we will collect the answers. The answers you give will be anonymous. We will not know who has given what answer, but the cumulative results of the poll will tell us a lot about our audience. While we wait for the poll to be completed and the answers counted, let me tell you just a little bit about CEC. CEC just completed a 5-year strategic plan, and we are now implementing it this year with a foundational framework built around climate policy, justice, resilience, and leadership. Our leadership program is creating events like this that build the base for climate knowledge that we hope inspires others to act. So where are we with the poll? Do we have any results yet? Let's see what has come up. Okay. Interesting. What we can see on this poll is that about 58% of audience have a will. And then 75% have a living trust. And about a quarter of us have the will updated within the last 5 years, which is an important thing. We maybe we'll talk about this later. And then your will, 54% have a will that contains an advanced healthcare directive. 42% contains a dual power of attorney, and 42% includes charitable gifts. Now, this is interesting because on a national basis, Santa Barbara is a very sophisticated community. To see here that about almost 60% have a will is above the national average. Nationally, about 60% of Americans have adult Americans have no will. And in fact, will pass away without a will, many of them, which is a very unfortunate thing to happen. So let us close this and begin our actual presentation. We have with us, and we're fortunate to have a panel of highly qualified experts here from Santa Barbara, and I will introduce them. Can we do a gallery of the people on the Zoom, so you can see the panel of experts, and you will see them during the presentation as well, of course. But I will introduce each one of our experts during the presentation, and at the end of the presentation, we'll share the email address of each one of our experts, of our panelists, so that you can follow up with them if you have further questions or if you would like to engage the services or anything like this. But let us start out with a very fundamental question. And this is, so if you want to do estate planning, what do you need to do? And there is a very fundamental set of tools that are really foundational to all estate planning. And Hannah Buschbom will tell us about those foundational tools. Hannah Buschbom is a wealth advisor and owner of the Ameriflex group. Her specialty is working with people, especially women, during a significant life transition, such as retirement, sale of a business or real estate, change in marital status or loss of loved one. She holds the Certified Financial Planning, Certified Divorce Family Analyst, and Certified Financial Fiduciary designations, along with industry-required licenses. So I'm turning over to Hannah now and ask her to tell us about why it is important to make an estate plan.
Hi, Karl. Thank you so much for having me. Can you hear me all right?
Yes.
Okay, good. That's always the first step, right?
Yes.
Thank you so much, everyone, for spending a little bit of time with us this afternoon, this evening. We understand you're busy, and we'll try to keep this impactful and interesting. I do want to bring up slide 5 if we can, because I think it's a really great visual representation of what I would hope to cover today. And that is the what makes up your estate. So what is all of the different items? So if we can bring up that slide, that would be really great. Couple back, Maddie, if you don't mind. Should be the one with the big diamond ring on it, the slide with the big diamond ring. And we appreciate your help, everyone. And while he brings that up, it's a fairly simple question. Your estate is everything comprising the net worth of your portfolio. So that would be everything tangible all around you. If you took a pause and looked at your desk, that would be all parts of your estate. But it would also be, things like your house, your car. And thank you for bringing this up. That's perfect. All of these pictures represent what your estate is. And when we're talking today, it's often important to think of things that are unique and different. On the screen is a picture of a piece of artwork or digital assets like potential stocks or bonds that you may own. And we've got a popular option with our younger generation of GameStop on the screen. So who would benefit if you were no longer on this planet, and where would these things go? And that really is what estate planning is all about. Ideally, you get to direct it and you get to decide. And what we like to say, a lot of the experts that are on this panel, is that if you don't direct it in one way or another with some of the tools and techniques that we're going to discuss today, someone will have to make that decision for you. It could be the IRS, it could be your next of kin, it could be someone else. But all of those could be different situations where the decision will be made by someone else. And when I talk to people about estate planning for the very beginning, it's often really difficult to plan for something you literally aren't going to be on the planet for. Death is a difficult subject to address, no matter whether we're talking about it in a positive light or unfortunately during tragedy. But the purpose and goals of estate planning are how to maximize your legacy. So who are you when you are no longer here? Take care of your loved ones, but also maximizing your financial resources while you're alive. So an estate plan is equally as important to direct what happens after you're no longer on this planet, but also to make sure that your gifts, your legacy, and you don't run out of resources while you're here on the planet. They're intertwined. For example, we'll talk about strategies that allow you to leave money after you're gone, but benefit from a reduction of taxes in today's dollars, or potentially even generate passive income to help pay your bills in retirement. So all of those things can be intertwined with the conversation that can be somewhat uncomfortable for others. The last thing I want to touch base on are the roles of gifts in estate plans. We're going to talk about gifts in general, although of course we're grateful that CEC has generously brought us all together today. Gifting today allows your loved ones or charities to benefit from your gifts right away and allows you to see the enjoyment of those gifts. In addition, those gifts can grow in value in the charity's hands or even your loved one's hands rather than yours, which helps reduce your taxes both today and in the future. So with that, I'd like to pass the mic to Deborah, who will share with us a little bit about some of the techniques that allow you to direct your gifts.
Thank you, Hannah. Well, let me tell you about Deborah Boswell. Deborah Boswell is a partner in the law firm Mullen and Henzell. She specializes in estate planning and trust administration. Her estate planning practice is focused on working with and advising clients on comprehensive estate plans, including revocable living trusts, wills, powers of attorney, and advanced healthcare directives, as well as more complex planning involving irrevocable trusts and special needs trusts. So please, Deborah, tell us about wills and trusts.
Okay. Thank you, Karl. It's nice to be with you all this evening. I know that from the survey that was taken, it looks like most of you have either a trust or a will, which is good. So part of this may be a little bit basic since you've already kind of gone through the process, but just so you know, one of the first things to know about, why do I need a will? And I tell people that if you don't have a will, then California is going to write the will for you. And most people don't want that. You want to be the one to write it and decide who's going to be the beneficiary of your estate. Now, in California, most people, and I noticed on the surveys, said that they had a trust that more than even people that have a will. And I just want to give you a little bit of a difference between the two. First of all, with a will, it's what most people think of. They'll call me, I need to do a will. And so that's the main document that people think of when they're going to do an estate plan. And when you have a will, the testator is the person writing the will. It's you, in that will, you name an executor, you tell who's going to be the beneficiary of your estate. But while you're alive, the will really has no power at all. It only comes into effect when a person dies. A will is admitted to probate, and it's only after that court process that the assets that you have go to the beneficiaries that you name in the will. The probate process in California is pretty onerous. It takes a long time. It's expensive. So in California, most people opt to create a living trust. And with a living trust, it's a way to avoid that whole probate process. So what you do with the trust, which is a little bit different, it's you're the person that establishes, we call it a settlor, a trustor, a grantor. You're also the trustee, meaning it's your assets. When you create the trust, it's a living trust, they're your assets, and you're the beneficiary during your lifetime. So you fill all those three roles. And in the trust, it's like the will. You put you're going to name in there who's going to be your successor trustee when you're either incapacitated or on your passing, so that somebody can step in and act on your behalf if you're not able to. And also, when you have a trust, it's in the terms of the trust where the dispositive provisions are contained, where your assets are going to go. So they're usually embedded in the trust, they're not in the will. One big difference between a trust and a will, like I said, a will is not effective until you die. A trust is immediately effective upon establishment. What you do, though, there's a little bit more involved with the trust in the beginning, because you're tasked with putting your assets in that trust, except for retirement accounts and other accounts that are controlled by beneficiary designation. So you put your house in the trust. If you have brokerage account, all of those assets are put into the trust, because the whole purpose of putting assets in the trust is to avoid probate. So that's a very significant part of it, of establishing a trust, is to be sure you have all your assets in the trust. Once established, the trust can be amended as many times as you need to. I've seen people minimum 20 times if they want, but they are amendable. You don't have to change the date on them. If you decide to amend them later on, it still keeps that same date. And so another good reason for having a trust is people living longer. Trust allows your successor trustee to manage your assets if you're incapacitated. So it avoids the process of a court supervised conservatorship. The other two documents that I just want to briefly mention, that when somebody comes in to do a trust, we also will help do a power of attorney, which allows their agent to act on their behalf if they ever become incapacitated and can't do so, act on their own behalf for non-trust assets, say a retirement account, filing income tax returns, doing all those type of things that are not covered by a trust document. And then we do the healthcare directive where you're naming your agent to handle healthcare decisions if you're not able to. And along with that, even when you have a trust, and I'm kind of curious because I noticed on the survey that more people had trust than wills, probably many people that have trust also have a will, but we call it a pour over will, meaning just in case you left out some asset, your will says it's going to pour into that trust. It may have to go through probate, but at the end of the day, it's going to go into the trust to be distributed according to its terms. So that's why you still need a will, even if you have a trust, in case things get left out, and that does happen. So that's just it in the gist of what a basic estate plan, involves. Of course, there's a lot of unique things can happen with people's unique lives and what kind of provisions they want to contain. So that's it for me. And I think the next person.
Thank you, Deborah. That's wonderful. Yeah, excellent. I want to just stress one thing, the importance of the healthcare directive in the trust. I personally have experience with being in a situation where decisions had to be made for somebody, but medical providers cannot accept directions from somebody who is not clearly identified, documented as having the power to make those decisions. So they have to make the decisions according to different kinds of principles. So thank you very much, Deborah. This was great. The planning, estate planning has multiple kinds of things that run together. And this is how we provide for the rest of our lives, how we provide for our heirs, how we also shelter our resources as best as we can. And this all involves taxes, of course, and there are some interactions between all of those issues. And one of the person who will tell us about is the wonderful Jane E. Russell. Jane is a CPA, excuse me, a partner of MacFarlane, Faletti and Co., and has been with this firm for over 30 years. She specializes in individual and small business taxes and also runs the day-to-day operations of the firm. She's originally from Western Pennsylvania, had the good sense of coming to Santa Barbara, and her spare time is she spends some spare time with her dog, Ziva. So welcome, Jane, and please tell us about the tax implications of all this and more.
Thanks, Karl. Can we put the next slide up, the purpose of estate planning? Okay, so let's talk about the purpose of estate planning. As we all know, it's when we die and not if we die. So why not let's do some planning for our own demise. If there's one thing that the pandemic has taught me is that we're very uncomfortable with the unknown and not knowing what happened to us or our loved ones. According to Wikipedia, estate planning is the process of anticipating and arranging during a person's life for the management and disposal of that person's estate during the person's life in the event the person becomes incapacitated and upon their death. So what are some of the main areas that we consider as we're doing estate planning? The first one, do we want to focus on growing our assets or producing income? The answer to that kind of depends upon whether what the assets that we have accumulated and inherited in our lifetimes and how much we've been able to save. Also, what do we need to do to be able to live comfortably and enjoy our golden years without worrying about running out of resources? A good financial advisor can help you determine these answers and set goals towards achieving them. Your goals may vary based upon your health, your projected life expectancy, your cost of living or standard of living, and your personal bucket list. So how do we minimize the requirement to pay taxes, either now or when transferring assets to our heirs during our lifetime, or bequests upon our passing? Well, as of January 1st, 2020, the California probate is required when your assets outside of your trust total over $166,250. And as all of us in Santa Barbara know, that means if you own a house, you better have some planning in place here. Your assets include your home, any vacation residence, your cars, your jewelry, your artwork, your savings account, all your personal property. So setting up a trust and putting all your taxable assets into it can help prevent probate, which is, as Deborah mentioned, a lengthy, intrusive, and costly process. So transfers during your lifetime can be done annually to your heirs without needing for gift tax reporting. The way you do that is to keep your gifts below the annual gift exclusion amount. For 2021, the annual gift exclusion amount is $15,000, and that amount increases to $16,000 on January 1st, so within the next month. Direct payments either to medical or educational expenses directly to the providers are not included in those gift tax reporting thresholds. So bringing your taxable estate below the estate tax filing threshold, which is projected to decrease drastically in the next couple of years, we don't know what yet, can be done through systematic annual gift tax planning. Currently for 2021, the estate tax threshold is 11.7 million per person, or 23.4 million per couple. But as I mentioned, we are projecting that it is going to decrease drastically in the next several years. So how do we make sure our wishes are followed when we pass, or if we should become incapacitated? I know one area that we really emphasize to up-and-coming CPAs in our firm is regarding documentation. If it isn't written down, it doesn't exist. So in estate planning, we use trusts to document who's responsible when we're no longer can be, what their role and duties are, what our directives to them are regarding our final health decisions, and what to do with all our stuff when we're gone. If we're fortunate enough to have assets and resources that exceed our personal needs during our lifetimes, how do we determine what to leave to our loved ones, and how do we provide for those causes we're passionate about? Estate and gift planning can help you feel more comfortable in determining which planning tools work best for your situation. So now we're going to pass it back to Hannah, who will go over in more detail about different ways you can balance gifting to your heirs and incorporate philanthropy in your estate planning.
Thank you very much, Jane. Before we go on to that, let me break in with a question. Somebody, Ivory John, asked, it's a question for Deborah primarily. Is there a threshold of assets to trigger probate? For example, assets that may be left out of a living will?
Well, it's what I think Jane alluded to, that if you have more than $166,250 in an aggregate amount of assets and several accounts, then you're in probate.
Mm-hmm.
So it's a low threshold.
Great. Thank you. Okay, so we move on, and one of the important things with estate planning is that it really can take care of a multitude of important needs and desires. And one of them is actually to do something good. Many people do not think about this as an option in estate planning, but to leave something behind for a cause you care about, you're passionate about, and that survives you as a lasting legacy. And to talk about this will be Hannah Buschbom. So Hannah, please tell us about charitable gift planning.
Great. So as we bring up slide 8, that would be, I want to talk a little bit about stepping back and saying there is a lot of planning that we're talking about today. And if you're feeling a little bit like, oh, I've got a long to-do list, it's totally understandable. But this is a segment of the overall estate plan that I talked about before. And so it's a segment, it's a purpose, and Jane alluded to some of the real great benefits for that. I'll highlight just 4 of them. It's reducing taxes, yours and of your heirs. So big one, it's a topic I'm having with my clients in quarterly or year-end reviews. What's going to happen with the tax situation? And I coordinate with everyone that's on this call, all of the different professions, to have that conversation. The bottom line is nothing is in stone yet. And so there is plenty of room for planning as we go into 2022. There is the benefit of making gifts that produce income for you, helping a cause that you're passionate about, and feeling happier and more fulfilled. I'll take you to a little stat from the U.S. Trust Bank of America study of philanthropy. In fact, over 56% of the general U.S. population, regardless of income or net worth, give some amount to charity throughout a year. And those with income of over $250,000 or a net worth of $1 million, that number rises to almost 90%. So while this may seem another thing to do, it is important because it seems like most of you are giving to charity and are choosing to make those lovely gifts. And we're just here to help you maximize those with all the goals on the screen. If we go to the next slide, I want to talk a little bit about some challenges that a lot of people identify when deciding to give to charity. Over 45% of the same study said that the hardest part is identifying what I care about and deciding how or what to donate to. And then the second biggest challenge to charitable gifting is understanding how much can I afford to give. And the good news is we're here to help. It's identifying causes is just a process. It's a series of questions that I'd love to show on the screen. On the screen are 7 questions on the next slide that you can ask yourself or your partner who helps you make family decisions. You can even have a family meeting about this to better determine where and how much and when to give. Another simple technique, if these questions are overwhelming, are just to create a cheat sheet. For example, you could have a worksheet that I'd be happy to share after this call. Perhaps I share it with Karl and he can forward it on. The first column, you simply list core values, like leaving the earth a better place than when I came into it. And then why is that important to your family? Well, one of your family members is a leading marine biologist and has watched how climate change has really affected the earth over your lifetime. So then you identify a cause, okay, climate change, and then finding charities like CEC or other groups in the community that support that cause and that original core value. And each family member can list a core value so that when you're deciding with the experts that are on this panel that how much you can afford to give and how to give, you have a great place of where to start. That can be really helpful for both Deborah and for Jane when they're thinking about how to set up your estate plan or your charitable gifting. The next slide I'd like to talk about are just some of the most popular strategies people choose to gift. These are really simple, easy to implement, and I won't go through them in too much depth as the poll identified most of you are sophisticated, but Deborah will talk about some more complicated techniques. The first is a simple one. In your will or your trust, you can say, I want to leave a percentage or a dollar amount to the charity or family member of your choice. A more sophisticated strategy or something that's a little bit in Jane's territory and thinking about saving in taxes is a lot of people have appreciated stock. This is the longest bull market in history, and a lot of people were smart to invest in tech stocks very early on, things like Apple, Amazon, Netflix, Hulu. And those stocks have risen to such a point that if you sell them, you'll have to give quite a bit to capital gains tax. Instead of giving cash or selling that stock, paying the tax and then giving the net proceeds, you can actually, many charities accept the stock itself without having to sell it. You can transfer it directly to them. The charity then sells it at their location, and because they're a charity, there is no tax for them. So not only do you potentially get a tax benefit in the year that you make that gift, but you also avoid paying that highly appreciated tax. And people who work in my shoes in financial advising and wealth management, we can actually transfer individual shares. So it's not like it's an all or nothing situation. Let's say you want to give one share that's $300. There's a $300 gift that could be more efficient than $300 after tax. This qualified charitable distribution that's on the screen, it's also known as a charitable rollover. Our folks that are over 70 and a half that are on the call actually can make a donation directly from their retirement account and send it to a charity of their choice and not have to typically report that income on their tax return. You can do that up to about $100,000. And of course, you'll want to work with someone like Jane to make sure that that's done appropriately, but it can be a great another way. And it's received at the charity like a check or a cash. So they're able to not have to deal with selling the stock or doing anything like that, but you avoid having to pay ordinary income on that income. And so this is where it gets into how much can I afford to give? And then where is the most efficient place to give from? These are all different alternatives than writing a check. Of course, your retirement accounts have beneficiary designations. Some types of investments accounts also allow you to list a charity itself. You can do this in percentage form. So let's say you want to give 75% of this to your children and 25% to a series of charities. Any sophisticated retirement account will accommodate multiple beneficiaries. And if something happens to both you and your spouse, you can even name a charity as a contingent beneficiary. This can be also something you may want to notify the charity if you do put this in place so that you can benefit from the impact of your gift now, even though it won't occur until after you pass. And the last strategy that I'll share with you, this is probably my favorite on the screen. Again, this is not given as advice, but it's just a really unique tool. It's called a donor advised fund. Many of the major institutions offer these, and you can kind of think of these as a separate piggy bank for charitable gifts. You typically lump this in a high income tax year. And let's say this is the year that you're going to retire, you have a bunch of performance stock options vesting, as well as a full year of W-2 income. And then next year, your tax bracket may go down because you're in retirement years. You can make one large contribution from your highly appreciated company stock into what's called a donor advised fund. Get a tax deduction for the full balance that you contribute in the year, in that high income year, and then make grants almost immediately or in the future from this donor advised fund to the charity of your choice, as long as they're a public charity. So this donor advised fund tends to be a great way if you're kind of a buckets of money person, where you've got the travel fund bank account and you've got the retirement bank account and you got this donor advised fund could be seen as your charitable bucket where you can make gifts. The minute the dollar goes in, you can turn around and write a dollar check to your charity of choice. And it doesn't have to be one, you can do it to many. So these are all really kind of unique, popular gift planning strategies that I'd be happy to share answer any questions or any additional information. Let's turn it over.
Thank you, Hannah. Hannah has just discussed a number of really basically very simple strategies to provide through an estate for gifts as well as heirs, almost all of which, except for bequests, have also some very wonderful beneficial tax implications for the donor. There are also somewhat more difficult strategies, more complex, I should say, not difficult, more complex strategies, and those are a portfolio of trusts. And Deborah Boswell will now tell us about trusts and walk us through that field. Deborah.
Okay, so a little more complicated gift transaction from some of those that Hannah was just talking about is a charitable trust. There's two main kinds of charitable trust. I mean, they all have different kinds of variations, but there's a charitable remainder unit trust and a charitable remainder annuity trust. In both of those scenarios, you have a donor who contributes property to a trust and in return gets a distribution of regular income from the process or the earnings from that gift. And then a charitable annuity trust is like a unit trust. The difference between the two are, with a unit trust, the donor gets a certain percentage of the value of the assets coming back in the form of a distribution. So say 5% of, say if there's $1 million that you're contributing and the value is $5 million or $1 million, then you could get a $50,000 a year regular income stream. Now and then if that value of the portfolio goes up, then the unit trust payment will go up, or if the value goes down, the unit trust payment goes down. Similar to the charitable remainder unit trust is the charitable remainder annuity trust. The difference between that one is that instead of getting a percentage of the value of the property in the trust, you get a set amount. So it doesn't matter if the value of the trust assets go up or down, you will always get that same amount. It seems like in my practice, most of the time we do the unit trust because it allows for greater diversity in investments, so that in years when the portfolio is not doing well, you're not depleting it by having a set payment. And so it just allows a little bit more flexibility in that. If you're going to go to the next slide, I'll just briefly talk a little bit about, well, I guess, yeah. Well, before we get to that, what I was going to talk, there's another form of charitable trust, is charitable lead trust. And the difference between that and a charitable remainder trust is that With the lead trust, you make a contribution to a charitable trust, but during the life of the donor or the term of the trust, the distribution is going to charity. And at the end of the term, then it goes to individuals like, could be children, spouse, whoever you name, to be the beneficiary of it. Many times we see that people put the charitable lead trust in their revocable trust that say when they die, they have a certain amount of money going into a charitable lead trust. So they get a deduction from estate tax when it goes into the to the charity. But after the charity has gotten a benefit from it for many years, however long the terms of the trust say, then their children or other beneficiaries get what remains. So those are the two main kind of charitable trusts. And I think, it's kind of confusing just to say, talk about, just the administration or logistics without really having an example. I think you just have to almost, get a real life situation. And so I have this one case study that we can see how this would work if we have established a charitable remainder unit trust. And in this example, we have a donor. He's age 65, and he establishes a charitable trust. We call it the CRT. It's decided that the donor wants to get a 7% unit trust payment annually for his lifetime. He's going to put $1 million worth of highly appreciated public stock, like Hannah was talking about the Apple stock or Hulu stock, whatever, put it into the CRT. He's doing this gift in this month in 2021. So once the stock is transferred to the CRT, that appreciated stock can be sold without incurring huge capital gains that would have happened if Dan had actually liquidated the stock himself and gave it to charity. And since as a charitable trust is tax exempt, there is no capital gains paid at that time. So once that highly appreciated stock is sold, then the trustee can invest in a more diversified portfolio. So, and the diversity would depend on creating a portfolio to be able to provide Dan with that 7% payout each year from the assets that are now in the trust. And like if in this case, we're using a 7% unit trust payout. If the value of the CRT is $1 million, then you would get an annual distribution of $70,000. If the amount goes up next year, it's still at 7% of that value. It's kind of hard to tell how the portfolio is going to do. So you might have some up and down years, but that's kind of the basic of what the expectation is of the donor. So for a unit trust, the range can be 5% to 50%. So that's 7% is in the lower range of what is permissible under the IRS rules for a unit trust. Now, if you go to the next slide, let me just tell a little bit more about the charitable deduction. In this example, when $1 million is contributed, the deduction, we run these calculations. Our firm uses number crunchers. I think a lot of the charities have their calculations for determining how much the deduction is going to be when you make a contribution to a charitable trust. You take into account, like this one, like I mentioned, Dan, is for his lifetime. He's 65. calculate what's the anticipated lifespan of Dan, so that we know about how long that the charity is going to be, or before the charity is going to get its remainder interest. We also, the 75-20 rules, it's the interest rate that that the IRS uses. You plug that in to find out what the rate is going to be, and then you do like the percentage with the payout. So all these numbers go into a calculation, a program, and it spits out what the charitable contribution is going to be for that deduction. So in this case, based on a contribution in December of $1 million for a 65-year-old donor, the deduction would be $339,270. The maximum that you can use for that deduction is 30% of Dan's adjusted gross income, AGI. If they doesn't have enough AGI to use all of that deduction, then the unused deduction can be carried forward for 5 consecutive years until it's used in full. So that's, it's a really a big advantage of not only, you're saving this, capital gains by contributing it to a charitable trust, but you're also able to get this deduction and have a lifetime income stream coming through. So on Dan's death, the balance of what's left in the CRT is going to pass to the selected charity. So say if it was CEC or any other charity that you name, at the end of that period, it's going to go to the charities. And as you can imagine, if the lower your payout is to the donor, if it's more like 5%, there's going to be more remainder interest going to the charities. There's also will be a higher deduction, charitable deduction, because because the calculation assumes that there would be more ending up going to charity. And when they ran this calculation, I put it in, say that Dan lived to be age 82, and the assets that were invested in a portfolio producing 3% growth and then 4% income. If on that basis and the payout was made every year for that 17 years, the remainder available to charity would be that $948,619. And in the meantime, though, Dan, over that 17 years, has received distributions in the amount of $1,160,959. So you can see how powerful this technique can be for somebody that needs a regular income stream, but also wants to benefit charity. And if it's ideal, like in this example, to use highly appreciated asset to put in the trust so that it's sheltered from capital gains. I should mention that when the donor, or like in this case, Dan, gets his distribution, it will be taxed what he's getting, but there's like a 4-tier rule where you get first is ordinary income, then capital gains, and then tax exempt, and then it's a return to principal. So there will be some income, tax paid on it, but it's not like it was all one big lump. If you sold that stock in the beginning for $1 million, it had to pay capital gains all at once. So and so this is, it's definitely a lot of people use this technique, when they have the right kind of assets. Most people aren't going to do this technique unless usually about $1 million or more is what we see most CRTs. I mean, the other panelists might have a different, seen other values. Sometimes I have seen 500,000, but it seems like it's usually more than that, because it is It is a separate irrevocable trust. It is a separate tax-paying entity. So even though it does offer great benefits, it's not a technique that you're going to use for a minimal amount of a contribution. So and usually too in these trusts, I mean, the IRS kind of gives you safe harbor rules for how to create these trusts so that they pass muster with the tax rules. But you can put, some flexibility, like who the charitable beneficiaries are. Some trusts allow you the donor to change the charities, but it always has to have the ending beneficiary has to be a charity. So I believe that's.
Deborah, I like to think of charitable remainder trusts as kind of a way to have your cake and eat it too.
Yeah. Okay.
Right?
Right.
You have an asset that you really would like to do something good with, but you also needed to rely on income from this asset for the rest of your life.
Correct.
So what you do is you put it in the trust, you get a tax deduction, you get lifelong income from the trust, and in the end it goes to a charity to do exactly what you want to do, to leave a legacy. I think that's a fantastic way to handle things.
It is.
It's very good. Thank you, Deborah. Before I pass on to the next, there was a question. I'll go back probably to Hannah or to Jane. Can living trusts and wills include sweeping statements to include all assets that might not be itemized? I believe this would include any accounts not specified, perhaps because such accounts might be newer than the trust or will. Or who wants to answer that question?
I would say, this is Hannah speaking. I would say that each year we provide an estate planning attorney an update to the client's Schedule A so that Deborah can then answer that question. That's what I would say.
Yes, because it's true that when people create their trust, we have a Schedule A, and that is the trust, the assets are they're in that trust at that particular time. But it is a living trust. People acquire and dispose of different assets, and the real key on that is to be sure if you open a new account, buy a new property, you remember that trust, you got to take title in the name of that trust. You got to always remember, now it's not you anymore, it's the trust that's going to be the owner.
And here's one more question before I move on, and it's a really intriguing question, but probably for Deborah. Is it possible to contribute stock options to a charitable trust, or do they have to be exercised first? That's a tricky one.
It's like with this, I kind of doubt. I mean, I think because you have to really look at the stock option agreement. I don't think that it would that's possible to do. I mean, but that's somebody else may know more than me. But I don't think that would be
okay.
I don't know.
All right.
Jane, maybe.
I think I have to agree with Deborah because stock options don't really have any value until they're exercised.
Yeah. Mm-hmm. Okay.
I would say certain in the money, which means they have a value, could be donated, but it's very tricky and it's plan driven. So the larger the stock option, meaning the larger the company, the more flexible the plan is. If it's a very small, let's say a local Santa Barbara company, the chances of the plan being flexible and nimble enough to allow for donations can be tricky. So
I would have imagined that you could contribute a stock option move it into a trust, but not actually receive tax benefits from it until the options are exercised. It would be more or less like a trust that is an income-only trust and has no income. But anyway, that's a complicated question. Probably needs to be discussed outside this webinar. what I do want to do at this point, move on to the next point, and this deals with real estate. I've been struck by the fact that very often people think of themselves as actually relatively poor, and that's in terms of the money, liquid money that's available in terms of the household budget. But they may sit on very significant assets, and in places like Santa Barbara in particular, those are often real estate assets. Somebody who bought his home many years ago at 100,000, and it's now worth more than $1 million, maybe a couple million. So those are very important assets that need to be thought about, and very often do not figure in our assessment of our own financial capacity. We have Hank Postma to talk about real estate. Hank is president and CEO of Heritage Realty Partners. He has been working in fiduciary real estate on the Central Coast for almost 20 years. 11 of those were spent working in the trust department of Santa Barbara Bank and Trust, later Union Bank. In 2020, he went out on his own and started Heritage Realty Partners, a full-service real estate asset management firm. So Hank, please tell us about real estate.
Thank you, Karl. Yeah, if you could pull up the slide showing the chart of the housing price index and how that shows the appreciation of real estate. It's something that Karl just touched on, and that many of you are well familiar of. If you've had a 30-year mortgage and paid that off, more than likely you've seen your home value double or triple during that time. This is based on the last 40 years. And as Karl also mentioned, in Santa Barbara, we now have an average home price of $1 million. So it becomes a very large part of people's portfolio, and something that they don't always bring into account when they're getting into the wealth planning. Donating real estate is something that can be an excellent way to deduct taxes while benefiting your favorite charity. This is something that I created a case study for, a little more simple than one that Deborah had created. And as Deborah has mentioned, as well as Hannah, there are very specific ways that you can get more customized with the way that you donate your real estate. But the one that I had put together was an individual who had an appreciated home for about 27 years, inherited that from her family, and was renting it out. The original cost basis being $350,000. When she decided to charitably donate the property, that asset raised to $950,000, creating quite a bit of capital gains for her and giving her sort of one of two options. You can go to the slide where it shows option 1 and option 2. Option 1 would be to sell the real estate and then donate the after-tax proceeds. And option 2 would be to contribute or donate the real estate directly. As I had mentioned, there are more complex ways of doing this, but a very straight line approach. You can see that the option 2 will give the donor quite a bit more in tax savings, as well as avoiding a lot of capital gains through the donation of that real estate. Something that is, if you're doing this in your lifetime, can also be passed on for 5 years, which I think Deborah had mentioned in one of her slides. If it's something that you'd like to donate real estate past your lifetime, there is something called a life estate reserved or a life estate in property. You can donate property that your child can live in or rent out during their lifetime, possibly a nephew or niece. And this is something where you're naming the remainderman charitable interest, sort of an insurance policy for you as well, to allow you to have your home avoid any kind of liens from housing agencies or places where you might live after your death and will allow you to maintain that benefit for the lifetime of your child as well.
Well, I'm actually, you have something else, Hank, that you want to add to that?
No, I'll wait for some questions. It
Great.
looks like a couple questions are rolling.
Excellent. Well, I'm absolutely amazed. We have taken exactly 1 hour for the presentation, just the way we had planned it. It rarely ever happens like this. But thank you, Hank. That was great to learn about real estate. Real estate truly is a very important issue particularly in places like California where real estate is very high, but it's going across the country now. And using this asset with planning and good strategy really makes an enormous difference. So at this point, what I'd like to do, thank all the panelists, Hannah and Deborah and Jane and Hank, and turn to questions now. There's one question that's up already, and then more probably coming in. So please post your questions. But the question that I have in front of me here is, if a couple creates a will and trust, and the wife or husband dies, can the remaining individual make unlimited changes? Who would like to answer that? Would be Deborah probably, or?
Yeah, I'm glad to answer that. So it all really depends on the trust instrument, you know, and this is a surprise to a lot of couples when one of them passes what their trusts say. Some trusts will say when the first one dies, the other one, it continues on for that person's benefit. They can change, do whatever they want. But there's a significant amount of trusts out there that say when one spouse dies, it splits into two trusts. One that has the deceased spouse assets and the one that has the survivor's assets. And the one trust is irrevocable, meaning that the survivor can't change it. They get the benefit, but they can't change it. So you have to really look at the trust instrument.
I think one of the questions I would like to ask at this point is, if I want to make a will, can I just download a form for making a will and do it myself? Or do I need to go to an attorney?
Well, you can do that. There's a lot of litigation out there when people have done that. But I mean, it's some people, it's, you know, some simple things people can get by with doing. You know, California does allow for a handwritten codicil if you're at the last minute need to write something. But a lot of times, because of all the contingent provisions that you've got to incorporate, sometimes you run into problems.
Great, and I think that's true. All the advice I've ever gotten over my lifetime basically is, don't do the will yourself. It needs a real expert to make sure that it's done right and that everything is taken care of. So I want to add that. And here's actually a question that goes right along with that. I don't have a will or trust. Where is a good place to start and or figure out what I should have of those at my stage of life? And before, and any one of you can jump in and answer that, but before you do, I want to say, if you want to go to the CEC legacy giving website, and again, this is not a solicitation, not at all, but there is an opportunity to download a guide to estate planning and will planning. And there are some really useful guides that help you put down all the information that you will need once you do go to an attorney. And they need that information you have already ready. You don't have to pay for all those extra hours the attorney has to go through with you to ask you question after question after question. You can already have it already with you. But anyway, so how do you start? Go about to make out a will? Deborah, want to jump in?
Sure. Okay. So our usual practice is we always send out a questionnaire, and I'm sure, like even with Hannah and Jane, with any of your clients, you really want to know what their assets are. So we send out a questionnaire, and it lists all of the not only what their assets are that might go into a trust, but their retirement accounts. We also have them list all of their family members, their ages, relationships, all of that information, because really you don't want to create a trust in a vacuum, because everybody's situations are unique. And, you know, sometimes if you have a family member, like, you know, I deal a lot with special needs trusts, where somebody has to have special planning. I want to know that going in, that they have a family member that needs to have special attention to. So, you know, so that is part of the initial, and you're right, Karl, it's best to have that brought in to the meeting ahead of time. I like to see it ahead so that we can make the most of our time to know where we really need to focus the plan on.
Okay. Thank you. Should personal assets like cars, jewelry, etc., go into the trust, or be handled by specific designation, who gets what in the will? And would this avoid probate?
Well, I'm glad to answer that. You with, I mean, at the, anybody else can pitch in. With automobiles, we don't usually put in the trust, because DMV has their own provisions outside. And then it's one of those exempt assets for probate purposes. And you've got the, you know, the Lamborghini and the Ferrari, maybe you do want to put them in, but, you know, regularly, you know, vehicles we don't put in. With jewelry, other tangible personal property, we have an assignment where we assign personal property to the trust, because there's really no title documents that go with it. So and then or you can put specific bequests of jewelry in your trust, but we also, our practice is to include a special provision that allows the settlor to create a separate list of tangible personal property, where they can give these special items to different individuals without always having to come back and amend their trust. So if you want this ring to go to granddaughter, you want this picture to go to, you know, cousin, that you can have that separate list.
Before I go to another question, one follow-up on this is, what values are used when calculating car value to determine probate? Given low value, 166,000 for CA probate, is it best to register cars on the trust?
Well, the cars are exempt from the probate, you know, if it's so you don't, you know, you don't have to, unless there is going to be a probate because your other assets are over the 166,250, then you're not going to have to worry about a car having to go through probate on its own.
Okay. Now, there's a question, and maybe I'll turn to Jane for a change. And this is, what was it? Can estate taxes be avoided on life insurance proceeds?
Life insurance normally has a designated beneficiary. And so by designating the beneficiary, that is not included as part of the numbers that we're adding up to see for estate tax purposes. The same with retirement accounts, you usually have a designated beneficiary.
Mm-hmm. Thank you. And here is I think a relatively easy one. And maybe Hannah wants to talk about this. Or was it here? I've lost the question. Can a donor advised fund be designed to be distributed to one or more charities upon the donor's death? Or does the future DAF funding become the responsibility of the entity that housed the donor advised fund?
That's a great question. So the bottom line question is, what happens if I haven't created enough grants and spent down this budget of the donor advised fund? The answer is both. Usually the entity that houses the donor advised fund, say it's Fidelity, say it's something else, has an endowment program where they will follow your directions for a period of time, up to about 6 to 10 years, depending on the company. And if you say, hey, I want you to give $5,000 a year over the period of 6 years and then distribute the the benefit to the remainder, you can absolutely do that. But my favorite technique is to create a legacy of giving. You can actually name a successor donor advised fund manager. This could be a family member, a trustee, an independent third party. So if you had a executor of your will, and they can actually make grants and distribute the balance of the donor advised fund on your behalf. So if you want to do it over a period of time, that donor advised fund can stay in existence even after your passing. So they can be designed in both directions and are typically really flexible. They work a lot like a private foundation, where some people who, especially those with extreme net worth, set up private foundations. I would like to say they're private foundation-like, in that they have that flexibility to continue on a legacy giving even after you're no longer with us.
Thank you, Hannah. And here is a question I think I'm going to throw to Hank. This is, I have heard it is important for your child to move into your home upon your death so they can claim it as their primary residence. Is that true? Does that prevent death taxes, or does having your home in a living trust prevent that?
I recommend planning ahead of that circumstance. You can't always do so, but having your home in the living trust is going to help with that process. Also having a plan for who's going to inherit it. I don't think you can avoid the taxation on it. There will be a step up most likely, and Jane can confirm that, but that's going to also be specific to individual circumstances. And it could be a surviving spouse passes, and there may have already been a step up on some of that. So the taxes can get complicated. There's not any provision that if you move in secretly, you've secured the house from any tax situation. It'd be better to plan ahead. Like I was saying, if you want your child to inhabit the house, you can do a life estate for that child. That would guarantee kicking that tax can down the road a ways, possibly. But that would be something that if you have concerns, talk to one of the specialists on this call, more specific to you on how to, but you can't just escape taxes by moving into the home.
Also, Karl, I just wanted to maybe add to that, if I could. A lot of when they ask about moving into the house, and I don't know if it was prompted by Prop 19, that law that just went into effect, that there's a special arrangement that if it was the primary residence of the parents and then the child moves in and keeps it as their primary residence, they can avoid reassessment of property taxes up to $1 million. Before Prop 19, it was unlimited, and you got $1 million plus unlimited on your home. So I don't know if that had anything to do with the question, but we are getting that since February 19th or February 17th when that went into effect.
Yes, I agree with Deborah. That's what I was going to pipe in. You definitely want to put your home in your trust for income tax purposes. I think what the inquiry was asking was in regards to the new Prop 19, and there are some protections there if the family member moves into the residence in not having to pay property taxes on a reassessed value.
I think the real lesson of all of this is that since real estate is such an important asset and so highly valued in most cases, it really has to be handled with a lot of special care and a lot of thought in the planning. There's another question, and I'm not sure this might go to Deborah. Do people named as beneficiaries on accounts, policies have to go through probate?
Beneficiaries on what?
On accounts or policies.
Well, no, if you do name a beneficiary on an account, it doesn't go through probate. The only thing is that if you have a trust, I recommend that you not have a beneficiary designation on a non-retirement account, because you want the assets to go according to what the trust says and not according to the beneficiary designation. But if it's a retirement account and you have them, named on it, then it doesn't go through probate.
Thank you, Deborah. Do we have, Sarah, do you have any other questions out there that you have missed so far?
No, I think you covered them all.
Wonderful, excellent. Well, this then leads me to thank everybody. Thank all of you who tuned into this webinar, who took time out of your evening to do that. I want to especially thank our panelists for their contribution. They have very busy lives, but they are first-rate experts in their fields. I also want to thank CEC staff, particularly Kathy King, who is the Director of Climate Education and Leadership, and our tech expert, Maddie, whom you have seen on the screen occasionally, I think. So thank you to all of you for tuning in. I now would like to share a screen with the names of the panelists and our email addresses. All of us will be happy to get back to you if you have any follow-up questions, if you have any inquiries, if you would like to get connected somewhere. You can also always get in touch with me personally. My email address is on this screen. It's klhutterer@cecmail.org. And I will then lead you to our various panelists if necessary or as required or as appropriate. All of our panelists will be happy to answer your questions if you want to get in touch with them directly. And of course, they will also be happy to provide you with services if required. But this is not a solicitation of your services. This is just simply an informational session. You will receive a follow-up email in the next few days with a link to the recording of this webinar and other resources that you want to share. In fact, there is one more slide I want to show that has some additional resources on it on how to get some information on healthcare directives, which I think is such an important issue nowadays. CEC organizes events like this on a regular basis as it works to advance rapid and equitable solutions to the climate crisis. CEC is one of only 5 nonprofits in the county of Santa Barbara who hold the highest ratings possible on both Charity Navigator and GuideStar, 2 national ranking services for nonprofits. So having no other questions, I want to thank all of you attending. I enjoyed this session very much, and I hope you have all a great evening. And I also want to wish you a truly enjoyable and blessed holiday season. Thank you all very much. Bye-bye.